So I would like to just briefly review this accounting cycle, which we went over last Monday. We started from, the accounting cycle always starts from the beginning balance of each and every account. So specifically, starts from the beginning balance for all the balance sheet accounts, for all the asset accounts, liability, and stockholders' equity. Okay, those are the permanent accounts, and today we'll be introducing you the official definition, what is temporary account, what is permanent accounts. Okay, so we start from accounting all the accounts beginning balance, and then as transaction happens on a daily basis, we analyze and journalize these transactions. Then immediately we will post them to T accounts. So journal transactions, again, in a journal you see all the activities in a chronological record. In ledger you see them organized by accounts. So it's easy to see what happens on a specific day when you go over journal. It'll be easy to see account changes if you go over T accounts, the ledger. After a certain period of time, if we want to get to quarterly statement or monthly statement for a business, for this period of time, we want to know what are the transactions that happens and what is the summary balances for these transactions. Before doing the statements, we need to make sure that the adjustments are made. Okay, so in Chapter 3, the main focus was introducing to you what is adjusting entries. Remember, we want to bring up accounts balance to its up-to-date status. All right, so Chapter 3, we talked about adjusting entries, and on Monday we talked about completing the entire worksheet. So how many columns are there in the worksheet? Columns. We will start from what? What will be the first column? Unadjusted, trial balance. Usually we call it trial balance. So these are the amounts that before we do adjusting entries, that would be the first column, unadjusted trial balance. Second column, we do adjustments, and then we post the adjustments amount in the adjustment column. Okay, then after that, you finally have the amount that is up to date, either at the end of the month, or the end of the quarter. That will be the adjusted trial balance amount, the adjusted amount. Okay, after adjusted amount, really that column has all the numbers ready for financial statements, but oftentimes company may want to add another income statement column or balance sheet column, just to specifically put together revenues and expenses information, or all the other ones, asset, liability, equity. Okay, so some companies may have a 3-column worksheet, some companies may have a 5-column worksheet. But overall, in summary, the third column really has all the information ready for financial statements after doing adjustments. Okay, so after the worksheet, all the numbers are ready for financial statements. You can just directly use whatever is in income statement column and just copy it to the format of the income statement. Right? Income statement, we only take care of all the revenues and expenses. The purpose is to figure out what is the profit amount, whether or not the company actually has profit for a month, or for a quarter, or for a year. So after income statement, then you transfer net income or net loss into statement of retained earnings. So statement of retained earnings, you'll be updating retained earnings balance, and that will be used for balance sheet. Okay, balance sheet is the statement that has the most comprehensive information, has asset, liability, and equity. Income statement, it's only a part of equity, only revenues and expenses part. Statement of retained earnings is only about changes for retained earnings, the accumulated earnings amount. Okay, so this is in a nutshell. What are the financial statements? Again, what is the definition for those financial statements? What are the elements that goes into financial statements? Now today we'll be focusing on after issuing financial statements. There's still some of the remaining journal entries that we need to make in terms of closing the accounts. Okay, so today our focus really is the last 2 boxes here in the accounting cycle before beginning balance. Journalizing, posting the closing entries. Specifically, we want to close these temporary accounts. Revenue, expenses, dividends. These are what we call temporary accounts. Okay, and then after closing it, how do we do a post-closing trial balance? So the post-closing trial balance is an optional step. Companies may decide to do this. They may just skip this step. And so some companies, after closing it, they just want to have a sheet of the actual amount that only relates to permanent accounts. Okay, so after closing entries, some companies may choose to do post-trial balance as well, but that is an optional step. And then the following cycle starts again from whatever is listed on post-closing trial balance sheet, the permanent accounts, ending balance, will become next period's beginning balance. And then again, we capture journal entries, post them to T accounts, summarize the balance, do adjustments, do the worksheet, do financial statements, start from beginning balance again. Okay, so this is a general accounting cycle introduced to you in the first 4 chapters. This is the main process of all the daily transactions, how it gets to financial statements. So it could be monthly statement, it could be quarterly statement, it could be yearly statement. Right, so specifically, let's go into closing these temporary accounts. So again, this is a process that happens at the end of the period, after doing financial statements, after completing the worksheet. We want to zero out revenue, expense, and dividends account. So by zeroing out, that doesn't mean we're just erasing the information. That simply means that we are transferring those information to retained earnings. Okay, so really this process is just trying to link to statement of retained earnings. So remember that on Monday when we did the worksheet, I briefly mentioned that retained earnings account is the only account on the worksheet that you will see that doesn't have the up-to-date balance. Okay, all the other accounts, cash, accounts receivable, accounts payable, on the worksheet you have all the latest information. Only retained earnings is the account that we haven't actually updated in worksheet, because what goes into this account is all the revenues and expenses information. And we don't know this until we do income statement. Okay, while we do adjusting entries, a lot of the transactions relates to a type of expense, a type of revenue. So retained earnings account is the only one, sort of like an exception on the worksheet, that you don't see an up-to-date balance. You only see the up-to-date balance in the second statement, statement of retained earnings. So what this closing process is trying to do is to match up the ending balance of retained earnings in the T accounts and in the journal entries as well. Because beforehand, before we did the financial statements, retained earnings has not been updated, because at that point of time, we didn't know what was the summary of net income or net loss for the period. Okay, so closing entry, zeroing out, setting revenues, expenses, and dividends back to zero, that simply means we're transferring the amount into retained earnings. And then starting from next season, next month, or next quarter, you will be adding new revenues information here, new expenses, new dividends, if the company decides to give out any. Okay, so basically what this means is that whenever you look at an income statement, you can have full confidence that what you're looking at, the numbers only relates to that month. If it's a monthly statement, it states, for example, $5,000 of revenues. That's the revenue that you earn in that month. Not in the beginning of the year, not in the month later. It only relates to that month, that period of time of revenues. Same for expenses. The expenses you see on monthly income statement or yearly income statement only relates to the expenses that occurred for that period of time. So meaning it is not an accumulated revenue starting from the beginning of the business. If the beginning of the business was 10 years ago, the revenue is accumulated here, but not in the revenue account itself. Okay, so retained earnings captures the accumulated net income all along the year, transferred here. The revenues and expenses only represent a short period of time of information. So this is why we call them temporary. But this itself is a permanent account. Okay, so everything later on will be transferred here. This retained earnings is the permanent account, but all the other ones, revenues, expenses, dividends, are temporary accounts. Okay, we zero them out by accumulating the earnings to retained earnings account itself. Okay, so by doing this in details, there are 4 steps. There's 4 journal entries, 4 posting steps to do in order to get to the final balance of retained earnings. I actually just mentioned this already. Temporary accounts, we close them by transferring information to retained earnings. We close revenues, expenses, we close dividends. So if there are multiple expense accounts, we close all of them. If there are multiple revenue accounts, we close all of them. Okay, anything that you see on the income statement only represents that period of time. We zero them out at the end of the season after doing financial statements. Okay, so as opposed to this temporary concept, All the other accounts other than revenue, expenses, and dividends are all called permanent accounts. Okay, all types of assets, all types of liability, common stock, retained earnings, anything you see on balance sheet is called permanent accounts. Okay, statement of retained earnings is a little tricky because retained earnings itself is permanent, but dividends is temporary. Okay, but balance sheet accounts, all of them we call permanent accounts. So meaning that when you look at balance sheet, if you see cash account, it has, let's say, $6,000. It's the total cash that a company has now. It doesn't represent the cash that company just collected for this period of time. No, it's an accumulated cash amount. But if you see revenue $5,000, that's the revenue that only relates to that period of time. Okay, so going back to balance sheet again, if you see accounts receivable $3,000, then that represents all along from day one of the business up to now. There has been increasing accounts receivable, decreasing accounts receivable, but up to now, there's $3,000 that your company will be receiving from others later on. All the permanent accounts means that you never close them out. It's always there, but the balances changes as transactions occurs. And we never zero them out to any other accounts. All the balance sheet accounts is always there, but the balances would change based on transactions. Okay, so permanent account balance carries forward to the following period. Meaning if December 31st, there's $5,000 left in cash for 2012, then January 1st, 2013, you start from $5,000. Okay, so whatever is the balance that you see at the last day of 2012, that would be the balance that you see in the beginning of 2013. Okay, this is what it means by ending balance carries forward to the following period. So I'm not sure if you noticed that earlier when we talked about financial statements, income statement, statement of retained earnings, you would see the heading stating month ended or year ended. But if you see balance sheet, if you go to balance sheet heading, it's always at a specific date. That is because it's a permanent. It represents all permanent account information. It's always on a specific day, January 31st or December 31st. It doesn't say a month period of time because it is an accumulated information from day one of the business operations. Okay, so balance sheet is the statement in the heading. You will see it's different from income statement and retained earnings. It's on a specific date instead of a period of time. All right, let's move forward in terms of the detailed process, how we actually do this. In order to close accounts, what closing accounts means is that we want to zero out the balances. Okay, so the goal here is to make sure that the normal balance side for these temporary accounts has a zero at the end. So to do this, this is really simple math. Let's say if there's $5,000 of revenue and you want the goal to be zero at the end, then you just post something and journalize something on the opposite side. Okay, so we're trying to transfer revenue to later on in retained earnings, but by doing this, in the middle, we open up an income summary account. So this is really an account that you will never see in any statements. It's just for the purpose of doing debit credit. We want to transfer things to retained earnings. And we have this temporary account in the middle of the process. Okay, later on you will see this account just disappears when it gets to the very last step. So by doing this, we post in dollar amount revenue over here, and we transfer the $5,000 here. So this is the first step. We want to close revenue account to income summary. Income summary is just a new account opened up for the purpose of closing entries. You will not see this account anywhere else. You will only see this account open up in the process of closing entries. So just to help the debit credits when we transfer information to retained earnings, it stands in the middle. Okay, so this journal entry itself, you will see revenue be debited and then income summary be credited by whatever amount there is right now on income statement. Okay, so after doing this, remember revenue's normal balance is the right side. So for the most part, you will definitely see a type of a certain value here on the right side of the revenues after a month of business activities, after a quarter of business activities. What you do here is just debit the exact amount you see here and transfer that amount to income summary. Exactly the same for the purpose of making this account zero. So that's the first step. In terms of closing expenses, let's assume that there were $2,000 in total, and let's just say for simplicity purposes there's only one expense. So if we were to make this account zero, we'll be posting something to the opposite side. Credit all the expenses, exactly the same amount. Transfer this to income summary, $2,000 here. So income summary, you can think of it as having a same balance, normal balance side as retainer. Because we always put revenues on the right side, expenses on the left side, while we do this closing process. So the first entry will be debiting revenue, crediting income summary. Second entry, because expense has the opposite rule, so we'll be debiting income summary and crediting expenses. This is a second step. Again, the purpose is to zero out balances. That's why we're doing this. Just copying the exact same information there to cancel out this account. So after this journal entry, this account balance goes back to zero. When it starts in 2013, January 1st, it will start from zero. If you earn revenue, let's say after a week $1,000, you only see $1,000 there for the next season. Okay, we're closing this out. Second entry, by doing debiting income summary and crediting expenses, we also zero out expenses. So then you will start next season from a zero balance. You will add in new information related to expenses that incurred for that period of time. Okay, so these two entries will zero out those two accounts. Now we only have income summary, dividends left. Okay, so what we're doing in the third step there, close income summary, transfer the amount to retained earnings. What that means is really transferring net income. So by these $2 amount, it's pretty obvious that the company has net income here, that worth $3,000 net income. Now we want to immediately close out this account. So remember that this is just a temporary account that I opened up for the purpose of closing all this. So if we want to zero this out, we'll do something to the opposite side, transfer this $3,000 to the right side of net income, the right side of retained earnings, because there's net income here. And this brings up retained earnings balance. Okay, so once again, once you transfer revenue and expenses to income summary account, the first question would be whether the company this season has net income. If there is net income, put net income here. Otherwise, you will have a net loss on the left side. So in this case, there's net income, and then you want to close out this account. In order to make this part zero, you will be debiting income summary for the net income amount, and then crediting retained earnings for this $2,000. I'm sorry, $3,000. Okay, so then $3,000 now, the whole purpose of doing all these three steps is to transfer this net income to the right side of retained earnings. Okay, in accounting, this is how we do the closing steps. We open up an income summary account, do the debits and credits to zero out revenue and expenses. Then we immediately close out income summary account, transfer retained earnings to the credit side. Transfer net income to retained earnings credit side. So if it's the opposite case, in any case if there's net loss essentially reduces retained earnings, so you will have to debit this amount if it's net loss. But if it's net income, it brings up the accumulated earnings amount. So we'll be increasing this by crediting it. That will be the third step. One last step here, dividends. Dividends, we also consider this as temporary accounts. Remember, this is an account that only will be opened up if the company decides to declare dividends to shareholders. So it's not necessarily, you won't necessarily see this account every single season. But let's say there is $500 dividends given away to shareholders in this season. We want to close this account as well. So next season, when you see dividends, it only relates to that season's reward to shareholders. So when you look at this account information, it's not an accumulated information, not an accumulated reward to shareholders. It only relates to that season. Okay, so we want to close this account again. The purpose is to zero this, so we credit this. So originally the balance is debit side. We credit this, and then we debit it to retained earnings. Okay, remember dividends is also eating up a part of retained earnings. It reduces retained earnings. In the statement of retained earnings, it has to be deducted. Okay, so then overall you will have net income increasing retained earnings balance, dividends here decreasing retained earnings balance. So the fourth step really would be debiting retained earnings and crediting dividends. So if you look at this retained earnings account here, unless this is a new business, otherwise usually you will also have a beginning balance of retained earnings here. So let's just assume it's $6,000, assuming. So this retained earnings has accumulated earnings, let's say all throughout the past year, together there's $6,000 accumulated. Now this season we have additional $3,000 and we gave away $500 as a reward to shareholders. So overall, this account now finally would represent the same balance as statement of retained earnings. That would be $9,000 minus $500. So you will see $8,500 as the ending balance. And this amount should be exactly the same as what you see under statement of retained earnings at the end, the balance, and also what you see on balance sheet. So in summary, what this process is trying to do is to match this retained earnings T account to the same balance as what's given away, as the financial statements, what's given away to shareholders and creditors, what they see on financial statements. So before this process, really retained earnings account, you will only have the beginning balance $6,000 there in the T accounts. Right? But in the worksheet, we see their beginning balance as well, but in statements, we readily transferring net income information to the second statement. So we just want to match up that amount with the journal entries and also the accounts, specifically for retained earnings. Okay, so this is the only step where retained earnings balance will be updated. Before this, we don't know what was the total net income or total net loss. So all this information is only summarized in the first financial statements. So later on, we just go back to match up retained earnings to its current balance. So next season, we will start from $8,500 instead of the original beginning balance, which haven't considered this season's net income or dividends. Income summary is just an account temporarily holding all these information for the purpose of closing out revenue, closing out expenses, and closing out dividends. At the end, everything falls into retained earnings account, and this disappears. This being zeroed out, this is being zeroed out, this is also being zeroed out. Everything goes into retained earnings. Okay, let's take a look at another example. So let's say originally, for revenue T accounts, you have the credit balance $6,000, and now you want to close this account, then this will be the journal entry to make. So original balance $6,000 is on the right side. You want to close the entry by debiting the amount. And debit, service revenue, credit to income summary. So we're just copy and pasting, transferring revenue to income summary. Okay, second journal entry, here is an example where there's two different expense accounts. So normally for businesses, it's very likely that you'll have multiple expense accounts. You can have utilities, salary, advertising, rent expense, interest expense. All sorts of expense accounts will be closed together in one entry. Okay, so here's an example. If you have 4 of them, then you will see the credit side listing 4 accounts. Okay, this week you also have a homework on one of the problems on closing entries. You'll have multiple expense accounts, just list them one by one. And then add the total expense amount, then you debit it to income summary. Okay, so this is an example. There's $1,500 expense for one account, $500 for utility, add them together, $2,000, you want to transfer that to income summary account by debiting it. Okay, so by doing this step, this expense account, multiple ones, all of them closes out, zeroes out to having a new balance, 0. So what is the company's net income now? By doing these two entries, can you tell me what is the net income? 4,000, and how will we be transferring that to retained earnings? Want to try? As a credit to retained earnings, and then the other side will be debiting income summary, exactly. Okay, so you have revenue $6,000 there in income summary. Then expenses altogether $2,000, so net income is $4,000, you know this. And if you're confused with income summary side, just think about retained earnings. Okay, $4,000 of net income definitely increases retained earnings. So you'll be crediting retained earnings for sure, and the other side will be income summary. Okay, if income summary, if you find it very confusing, just think about the other side. If we want to close revenue, you know the balance, normal balance is credit, so if you want to close it, you definitely have to debit it. So once you know revenue, you have to debit it, the other side, you'll be crediting income summary. For expenses, by now you should know the normal balance is debit. So if you want to zero out, you have to credit expense. If you credit expense, then you will be debiting income summary. When it reaches the third entry, the only question you have to ask yourself is whether the company has net income or not. If there is net income, that brings up retained earnings balance, so you know you will have to credit retained earnings to capture this balance. Okay, the other side will be income summary. Now for dividends, definitely this reduces retained earnings, so you'll be debiting retained earnings. And dividends, if you want to close it out, you know for a fact the normal balance is debit, so you definitely have to credit dividends. And this reduces retained earnings by $800. Okay, so meaning for the $4,000 of net income, really what's kept later on in the business is $3,200 only, because $800 you gave that away. Okay, so the net effect, what really increases, what really goes into retained earnings, overall, $800 cancels out, there's only $3,200 accumulated in retained earnings account. All right, if we look at all the T accounts together, really this is the same thing as I showed over there. You have revenues transferred to income summary. You have expenses transferred to income summary. If there is net income, this increases retained earnings. You close out income summary by debiting that net income. If it's the opposite, if you have net loss, then you'll be reducing retained earnings by posting net loss here. Then income summary will be closed by crediting income summary. Okay, dividends. Always, when we close this out, we'll be crediting dividends, debiting retained earnings. So if you just look at retained earnings account for a minute, you have beginning balance, you have new net income information, new dividends information, and then you have the final ending balance, which will be the same as what you see in statement of retained earnings at the end, and also balance sheet. Okay, makes sense? Kind of? Okay, let's do an exercise on this. Now, if you're given an adjusted trial balance, again, adjusted trial balance has all the numbers ready for financial statements. And let's assume that all the statements are given out already. You completed all the statements and you want to do closing entries. Okay, so closing entries only relates to just this portion of the accounts. Remember, permanent accounts, we don't close them out. We only close revenue, expenses, and dividends. Try to figure out how to close them by doing 4 journal entries. And if it helps, you can also draw T accounts on your notebook if it helps you to understand the process. But try to summarize, try to journalize the closing entries and see if you can figure out whether there's net income or net loss. for this problem, where do we start? How do we close this entries? What's the first? Revenues. So we have $16,800 here. How do we zero this out? What do we debit and credit? Debit 16,800 from revenues, and then transfer this to income summary by crediting income summary 16,800. Okay, so this is the first step. Thank you. What about the second? Expenses, and we will be debiting 6,200. So you add this, all of them up, right? Okay, but specifically, if in journal entries, we'll be listing them separately, but the total amount will be $6,200. So by doing this, we'll be crediting all these dollar amounts and then transfer this to income summary. So income summary, debit side will be expenses, credit side will be revenues. Okay, so just by a quick glance here, it's pretty obvious that revenue exceeds expenses. So meaning there's net income for this season. So if we were to close this out as the third step, you'll be summarizing, first of all, the 10,600, which is the net income amount. There's net income, you'll be summarizing it under the credit side. And then in order to zero out this account, you'll be journalizing the debit side of income summary and transfer this to retained earnings account. Okay, so the third step will be capturing the net income information, transferring to retained earnings. But if we stop right here, these are the two journal entries for the first two steps of closing process. Okay, close out revenue by debiting revenue, since it's normal balance on the credit side. Expenses, we close them out by crediting all the expenses because the normal balance is the debit side. Okay, so for temporary accounts, really, the debit credit rule, when we close it out, just post it to the opposite side, transfer everything to income summary. Okay, so make sure you list all different types of expenses separately because we have separate T accounts for these. Right, but at the end, the total amount will be debited to income summary. So third step, since we have net income, we know for a fact that it increases retained earnings. So we know the third entry, the right side is definitely retained earnings. Then the left side, we close out income summary by debiting income summary. Using the $10,600, we have a balance here, the right side. This increases retained earnings because this is net income. So we have net income increasing retained earnings. The debit side will be income summary. Okay, now for dividends, really dividends is not related to revenue or expenses. It's just another temporary account. So dividends of the normal balance is the left side. We want to close out this account by crediting this $800. Transfer this to retained earnings. The reason why it's on the debit side is because it reduces retained earnings. Net income increases retained earnings. Okay, so after the closing entries, it's obvious that the net income is $10,600. Revenue exceeds expenses. So you will see under income statement $10,600, and after this closing entries, after you do the journal entries, post them to T accounts, you will have a new balance for retained earnings. So can anybody tell me how much this is? 26,400. Good. Yes. So the whole purpose of doing this is to update that retained earnings account. Otherwise, it still has the beginning balance from January 1st or February 1st regarding the specific statement date. You will still have the 16,600, same as what's there in the worksheet. So after doing this closing process, this will be the same amount you see in the second statement of retained earnings. Okay, so some of the companies really just stop right here. Right? For others, they may prefer to do just a post-closing trial balance. Really is just omitting these accounts that they readily closed out, that they zeroed out. So in the entire worksheet, you see all different types of accounts: asset, liability, equity, and also revenues and expenses. But in post-closing trial balance, just by its name, after closing these temporary accounts, what you would see at the end is just all the permanent accounts. Assets, liability in the middle, and it ends with equity accounts, and that's it. Okay, so post-closing trial balance, this retained earnings here is already the up-to-date retained earnings, the new retained earnings, the ending balance here. Okay, so that's the only difference between this post-closing trial balance compared to the worksheet, the adjusted trial balance column. Okay, the only difference is really just the retained earnings, that's all. All the other accounts is there, and also revenues and expenses are also different because we transfer that amount to retained earnings. Okay, so this is an optional step for companies to do. They may want to do this, and then they just start next season by looking at whatever amount is listed here. Those will be the beginning balance for the accounts. Okay, so you will see revenue, the balance will be zero until there's newly earned revenue by providing services, providing goods, then you will put the amount under revenue again. And until there's new incurred expenses, then you will add expense amount under expense T accounts for the next season. Otherwise, you will just see this beginning balances as the starting point. Okay, so for post-closing trial balance, you really just need to know the main difference between this and worksheet. I will not be focusing too much on this for midterms. You really just need to know the differences between this and worksheet. It doesn't have all the temporary accounts, and this is updated. That's all. Okay. Any questions so far? All right, let's move on to classifying assets, liabilities, and current and long-term. So I briefly mentioned this in Chapter 2, actually. This liquidity, how we classify assets and liabilities is based on the liquidity of these different types of accounts. So meaning how quickly a type of asset or how quickly a type of liability turns into cash receipt or cash payment will determine whether it's a current liability or long-term liability, or a current asset or a long-term asset. Okay, so assets, liabilities, typically in financial statements, will have separate categories for a current asset, for a long-term asset, for current liability, for long-term liability. So before this chapter, we have been omitting that separation. I've just told you to put all the assets together, put all the liabilities together. But really, in reality, the financial statements, you will see them have separate sections. Current sections are always listed together first, then you have long-term assets, current liabilities, and then you have long-term liabilities. So the real financial statement balance sheet is actually a classified balance sheet. You will have assets listed in the order of its liquidity, meaning in the order of how quickly it turns into cash. Okay, the quicker it is, it's more current. The quicker the liability needs to be paid off to others, then it's considered current liabilities as opposed to long-term. Okay, so this is just a definition and how we represent these information in the order. We always represent the current ones first and then the long-term ones. Okay, so what do we mean by current asset? Current asset, the definition is that all the type of resources that will easily be converted to cash within an accounting cycle. So an accounting cycle, typically the definition is about 12 months, generally speaking. So unless this specific business operation is very special compared to others, otherwise usually it's a year period of time. So cash is obvious, it's already cash itself. So cash account is definitely a current asset. Accounts receivable usually represents the future cash receipt, and typically this is only a few weeks of time. So usually accounts receivable will not exceed 2 months. There'll be a couple of weeks, oftentimes it's just within a month, that will turn into cash. Right, so accounts receivable, the definition is future cash receipt, but really it has a very quick turnover rate. So it's a current asset. It has to be converted to cash within a year. Okay. Other definition here, supplies. Supplies is easily been used up. So this is a type of resource that only has a lifetime within a business for less than a year. So usually if it's longer than a year, then we don't classify it under supplies account. Okay, so other types of like equipment, machinery, those are what we call long-term asset, which will be shown in the second slide. Okay, supplies represents, for example, like stationery in the office, the papers, the folders. Those are the things that oftentimes will be used on a daily basis or even a monthly basis. It can easily be used up within a year. So the lifetime is very short. That's what we call the current asset. Okay, prepayments. Remember, prepaid expenses is a type of asset. You can be prepaying rent, prepaying insurance. And if you link this to Chapter 3, the adjustments we make, the reason why we make the adjustments is because oftentimes this prepayment, after a certain period of time, a part of it expires. It's no longer in force. So those also has a lifetime that typically is within a year. You prepaid insurance for 6 months, you prepaid rental expense for 6 months. Then as time goes by, it expires. Those are the part that we do adjustments. So the lifetime for prepaid expenses oftentimes is within a year as well. So we consider this as current assets, meaning if we prepay $3,000 for the next 3 months of a certain benefit, it will be listed in the current asset section. Now, inventory, we'll be talking about this account a lot more in Chapter 5 and 6. So here you just have to know that it's part of current asset. So basically it represents the product, the merchandise itself. So anything that you see in the retail stores, all the different types of products are considered inventory. Okay, inventory is a general category representing all the products specifically for merchandising operations for the purpose of getting revenue. Okay, so anything that you can see in the physical store for customer to purchase, the value there is considered inventory. That's used for merchandising operations. In the first 4 chapters, we talked a lot about service revenue. A lot of those companies really don't have inventory. They provide a type of knowledge, expertise. The thing that turns into service revenue is the time, the knowledge. But for other types of business who could be selling certain types of products, then this is the value of their asset, inventory. Okay, so long-term assets has the opposite definition. Anything that has a lifetime in the corporation longer than a year, then the value of that asset is long-term asset. So typically when you purchase a piece of land, it can be used for multiple years. Usually it doesn't, company do not just purchase it and sell it immediately. Okay, so land, building, furniture, equipment, we're talking about the business that don't use these long-term assets as a way to generate revenue. So really these are the long-term assets for them just to support their business operations. Okay, so if furniture, if you're talking about like an equipment company, then that's a different story. Then equipment is considered inventory. So here we're talking about long-term assets that's there to support daily business operations. You need a physical place, you need a warehouse, you need a store, rented place for you to hold all the inventory for customer to come to purchase. You need furniture to support the office facilities, have equipment to help you lift some of the products. So all the values that the cash amount, the value that these long-term assets holds will be listed under long-term asset category because it has a lifetime in the business for longer than a year. And if you link this to Chapter 3, remember long-term asset besides land, all the others we have to depreciate its value. Okay, the reason why we depreciate it is because it's there in the business for a longer period of time. We don't want to misrepresent the value of the asset. Okay, so as we use the asset, we will depreciate long-term assets value, typically spreading the cost along the years. Okay, just so that the creditors or shareholders, when they look at financial statements, they know that although this asset is there in your business, but after 10 years of usage, it's no longer, it doesn't have the same value as when you just purchase it in. So we usually depreciate it as time goes by, reduce the cost, reduce the usefulness, the value of those assets. But land is an exception. We don't depreciate land. Okay? All the other assets you see here, some of them will be introducing it to you later on throughout the semester. So don't worry too much about long-term investment listed in the textbook. It will be introduced to you later in Chapter 10 and 11. Okay. Now don't forget contrast account in Chapter 3. Accumulated depreciation always is listed right underneath furniture or right underneath building as we depreciate it, it is also considered a long-term asset account. Okay, it is always represented right below those long-term assets.
Are you sure if the land price goes down in compared to like when you bought it? You know, like the house price goes down, the value goes down.
We only would consider that whenever the company wants to sell the piece of land. At that time point, when they're able to set a price with whoever is purchasing it, then that will be the time when we capture land's value at that time point. But over time in accounting, we'll just have the land's value there as the same value when we purchased it before. Okay, so I think mainly because there's no real prediction in terms of it really depends on the area, right? So some areas you may have it prospering and the land prices goes up, some areas may go down. So that in accounting we prefer to have a historical value there, but we will definitely capture that if the company decides to sell it out. So that will be the time to capture the differences. Okay? But yes, so very good question. So other assets, that is the only one that we have the historical value there until we sell it out. Then we change it and determine whether there's additional revenue earned by that, trading those assets. Otherwise, all the other ones, we have depreciation accounts underneath it. Specifically accumulated depreciation. Okay, so this is also a long-term asset account. All right, for liabilities, same definition. Current liabilities, or we could call this short-term liabilities, has a lifetime within a year. So meaning that the company, if they have these short-term liabilities, they borrow money, they will need to pay it off, and also some of them with interest together within a year of time. Okay, so this must be paid either with cash or goods, other types of services in exchange within an operating cycle. So this is referring to also a year. Now, typically, accounts payable would be paid off within a few weeks as well, just like how accounts receivable is defined. So accounts payable usually don't come with interest. You just pay off the money. This typically relates to purchasing some of the supplies or other assets that has a lower amount of value, but you will pay it off immediately a few weeks later. Notes payable could be due either within a year or longer than a year. So you will see notes payable account either / short-term or / long-term. Okay, so later on in the semester, there will be different types of problems given to you. Notes payable could be both sides. Depends on the specific contract that you sign with the creditor. Okay, salary payable, interest payable, and earned revenue, these accounts, typically these are short-term accounts because you'll be paying off employees' salary, usually bi-weekly or bi-monthly. Interest payable, if it's listed as interest payable, and specifically it relates to short-term notes payable's interest, then it's also a current liability. So interest payable can also be both. Depends on whether it links to short-term notes payable or whether it links to long-term notes payable. Okay, so might have been able to guess long-term liabilities definition. Any liability that has a lifetime longer than a year. You don't need to pay it off immediately within an accounting cycle. You can pay it off later years. If it's a long-term notes payable, or for assets, if it's mortgages, if it's bonds payable, which we'll introduce in Chapter 10 and 11. All of these are liabilities that are not due within a year. You have a longer time frame to pay it off little by little. Okay, but of course, some of them, if you pay it off this year, it becomes current. But for those mortgages that for later years, then in a standpoint, when it is 2013, if it's a mortgage that you'll be paying in 2015, 2016, from the point of time right now, it's considered long-term. But for the portion that you're paying off this year is considered current. Okay, but overall, again, notes payable breaks down to two types. Notes payable can be short-term, can also be long-term. Okay, so the problems usually will specify, will tell you whether this is a 6 months notes payable, or if it's let's say 18 months notes payable. As long as it's more than 12 months, then it's long-term. Okay, so the whole purpose of going over all these definitions is, again, because balance sheet usually classifies the accounts based on its liquidity. So the quicker you need to pay off the liability, it will be listed up front in the liability section. If the lifetime of the liability is longer than a year, then it's listed in the second section. Okay, so this is usually how it's represented in a classified balance sheet form. We still have the left side asset, right side liability and equity. It's just that the left side you see current liability section, the current asset section, and then you see plan asset section. So plan asset and long-term assets are interchangeable terms. Okay, plan asset represents long-term asset. Current asset and short-term asset are interchangeable terms. So altogether you have current asset that worth $10,000, long-term asset altogether worth $65,500. So current assets are the ones that can be converted into cash or will be used up very soon in a year. In terms of liability, you see that there's current liabilities that were $19,600. All these accounts, these payables will be paid off within 12 months. Other ones, long-term notes payable, long-term, $20,000. We'll still see this amount in the beginning of next year. So will not be paid off within this year. Okay, so this layout of the balance sheet is not the only one used in the business world. This is called the account form. So the account form is the one that mostly for introduction financial accounting textbooks we use account form just because it mirrors the accounting equation. Left is asset, right is liability and equity. There's also another format, exactly the same information, just a from top to bottom format. This is what we call the report form. Okay, but it still has the upper part assets. We start from asset and again classify them into current and long-term. Then you have liabilities here, also current and long-term, and equity. Okay, all the information is the same. It's just either it's from left to right or from top to bottom. So you just have to know that there's two differences. I'll be focusing more on, for the homework for you, it's usually the account form. Okay? All right, let's do this exercise very quick together. Just try to identify whether an account is an asset, a liability, or it's neither. And then if it's an asset and liability, whether it's a current one or a long-term one. Okay, so this is important in terms of structuring the financial statements. You need to know whether it's short-term or long-term to be able to structure them. All right, so what is building? Building is a long-term asset. Accounts payable. Short-term liability. Total expenses. The short-term and long-term only relates to asset and liability. I think you were thinking of temporary accounts, right? But temporary accounts doesn't fall under balance sheet, remember? So we're only taking care of balance sheet accounts here. So total expenses doesn't apply to a part of asset or liability. Remember, it's equity, right? So total expenses is neither, not applicable. It's a temporary account, but it's not part of the balance sheet. Here we're just taking care of the permanent accounts and separating permanent accounts into current and long-term. Okay, now if we move on, accumulated depreciation would be asset, and specifically long-term because it goes hand in hand with either furniture or building or equipment machinery. Okay, salary payable, accrued liabilities. This is a type of liability and specifically short-term. Salary payable. You definitely don't want to work January 1st and then get the paycheck next year, right? So usually salary payable, rent expense, these accrued liabilities are considered short-term. It is short-term. Okay, prepaid expenses. Prepaid expenses is asset, and specifically it's short-term asset. So if you prepay something, usually you don't prepay it for 2 years. Oftentimes it's just for a few months in advance. So this is just, generally speaking, prepaid expenses, we rarely see it prepaid for 2 years or 5 years. Okay, otherwise it will be considered a type of long-term asset. So usually prepaid expenses, we define it as the assets, the prepayment that we make just for a year of time. Okay, so any type of prepayment, you just assume it as short-term asset. So which is why in adjusting entries, we will be adjusting them as time goes by. Those will expire, will be used up within a year of time. Okay, service revenue. Not applicable. Again, just like total expenses, it's part of equity, it's not part of balance sheet. So for identification, it's not asset, not liability. So you don't have to classify them into short-term or long-term. But it is a temporary account. Okay? Cash, asset, current. Okay, inflow and outflow of cash is very frequent on a daily basis. There's actually another statement that we didn't focus on now, statement of cash flows. That'll be introduced to you in the very last chapter. You can take a look at all the cash inflow, outflow based on different categories. Okay, accounts receivables. Asset, current. Right, you'll be collecting the cash in a few weeks. Interest expense. Neither one. So not asset, not liability, it's an equity account. Equipment, asset, and specifically long-term. Okay, so these are the identification and clarification, whether it's long-term, it's current. Just make sure that you understand the ones that do not fall under either one of them. Okay, total expenses, service revenue, interest expense. And from the responses I heard, prepaid expenses, make sure you understand this. Asset accounts, and it's a current asset account. Okay, service, and also the other one, accrued liabilities. Accrued liabilities is also short-term. Okay, once you know what is short-term and long-term, this is also useful for the last part of the chapter. Okay, besides looking at financial statements, the performance is just by its number for each and every account. Oftentimes, users of financial statements also do some analysis with the numbers. So instead of just looking at the numbers itself, of course that has all the information there, but they often use some of the ratios, and throughout the semester we'll be discussing some of the ratios, not just these two. There's also other ones to help you analyze the business. You can think of it as analyzing the business health position in terms of how risky it is, whether it's profitable, whether there's actually indicators that indicates that the business is doing pretty well, is prospering, based on some of the ratios. So you look at financial performance in different angles. All of them has a specific purpose. Okay, so accounting ratios, the purpose again to measure business operations, the position of this business, and specifically in this chapter, to you two of the elementary ones: current ratio and debt ratio. In current ratio and debt ratio, in order to calculate these, you have to know whether an asset is considered current or long-term in order to determine this. Decision makers often use different types of financial ratios in different angles, different aspects to evaluate business. So if the majority of the ratios they use to analyze all gives you a positive information, positive indicator, then that represents a company that, for example, creditors will be able to lend money to. Or you, as shareholders, investors, you want to invest your money to, provide capital to the business. Okay, oftentimes ratios are used specifically analyzing information that you see represented on financial statements. Okay, so what current ratio means, this ratio here we want to measure, current ratio, we want to measure the liquidity within a year by comparing current assets over current liability. So meaning we want to look at the total value of current assets, add them all together. This includes cash, accounts receivable, supplies, all the short-term assets value, then divided by current liability. So all the short-term notes payable, accounts payable, anything that is a liability that is due within a year. So what this is trying to represent is per dollar of current liability, how much current asset does a business have to cover this liability, to pay off this liability that is coming up, that will be due within a year of time. Okay, so we want to know, we add up all the current assets value divided by current liabilities. If this ratio turned out to be somewhere around 1.5. Above this will be considered very strong. So 1.5 will represent for every dollar of liability, you have $1.05 of current asset that you will be able to use this current asset to pay off the liability. Okay, remember, liability is either paying off by cash or other types of current assets in exchange to pay back the money that you borrowed or that you haven't paid back. Right? Current ratio of just 1 would be considered pretty low and risky, because that would represent for every dollar of current liability, you only have $1 of current asset to cover that. So after covering it, meaning you don't have too much left. Okay, so 1.5 is considered a strong current ratio. If it goes below this and it reaches 1, this threshold here, then it will be considered pretty risky. So meaning company would prefer a high current ratio. The higher this amount is, the better off this indicator represents. Having plenty of current assets to pay off its current liability. This is a pretty elementary ratio, but it would be a first indicator as a starter of looking at a certain type of business financial statements. You can evaluate and get a sense of the liquidity of the assets. So this ratio here is looking at the short-term performance, so how you pay off the liability with assets. Debt ratio will be looking at a longer period of time. So we want to measure a business's overall ability to pay the total liabilities. All the liabilities that you currently see on financial statements, we want to add them up divided by total assets value. So total liability basically will be including current and all the long-term ones. Total asset would also include the current asset and all the long-term assets. Okay, so this ratio here, its name is debt ratio. You see debt on the numerator side. So just by looking at this ratio here, the lower the better. Okay, so it's like the opposite of current ratio. Current ratio because we have current asset as a numerator. So the larger that number is, that represents the more current asset the business have, or the lower current liability that the business has. The debt ratio here will flip the sequence here. We want to calculate the total liabilities over total assets. So we want to know the ratio between liability and assets in total in a longer time period, not just the current ones. The rule of thumb here is about 60%. And that will represent for every dollar of asset represented on financial statements. At the same time, if you look at the right side of liability, for every dollar of asset, you have $0.6 of liability in total. Okay, so the rule of thumb here is that if the ratio is below 60%, it's considered pretty safe and less risky. If it is above 60% and it reaches even to 0.8 or 0.9, then that definitely is a very risky indicator. Because that would represent for every dollar of asset you see on the right side of the financial statements, you have $0.8 of liability, which basically means you only have $0.2 of net worth of equity. So you definitely want net worth of the business to be as large as possible. So debt ratio here, 1 versus 0.6. This is considered pretty safe. Anything below this dollar amount is great. If it reaches above, if it's above 60%, reaches 80% or even more, it's a very risky indicator, which means they currently have a heavy debt already in the business. Okay, so for creditors, this will be a negative sign if they want to borrow money to the company and the debt ratio is very high. This is a negative sign. They may not have enough asset to pay off the money. All right, so current asset over current liability, the higher the ratio is, the better the company is able to pay back its current liability with its current asset on hand. Current ratio, the higher, the better. So if it exceeds 1.5, that's great. Even above, that will represent the company has enough current assets. Debt ratio, we're focusing on the debt amount in the numerator. So the lower the ratio is, the better the company is doing in terms of having a stable amount of asset to pay off its liability. So the higher the ratio, that only represents the more debt the company has compared to its total asset. All right, let's do an exercise very quick. Try to first of all classify these assets, liability accounts, and just leave out anything that is not asset and liability. We're just focusing on current ratio and debt ratio here. So again, if after classifying, try to see if you can calculate current ratio by totaling up current asset divided by total current liability. Second ratio, total debt, total liability, total asset. Okay, from the above dollar amount, just add up all the current asset divided by current liability. See what is the ratio you get. Second one, add up the total debt divided by total asset. See what is the ratio, and if you're able to evaluate the financial position right now. But don't forget to do this weekend's homework. It's also due next Tuesday. Originally, I didn't give you homework because originally next week was midterm. Since I pushed back midterm, so next week we'll still have homework to do, and it's due Tuesday. Okay? It's on chapter 4. Should I erase this? Okay, now to calculate current ratio, we want to know current assets over current liabilities, debt ratio, total debt over total assets. So let's just classify the upper accounts first. Notes payable specifically tells us it's long-term liability already. So notes payable you have here $7,800 as long-term category. Prepaid rent is a prepayment. Prepayments are assets. That falls under current asset category. Salary payable is short-term, $3,000. Have salary payable there. Service revenue doesn't apply to this. Supplies, $500 is asset. Accounts payable, short-term liability. So accounts payable, you have $3,700. Cash, depreciation expense is an expense account, so this does not apply. Equipment, long-term. Okay, so you have 3 current asset accounts. If you add them together, that will give you the 3 asset accounts, add them together, that will give you $12,000. Total current liability, you'll be adding up the $3,000 plus $3,700. That will give you $6,700. For debt ratio, total them up. Okay, so total liability, total assets. Okay, so for these 2 ratios, the first one here, total current asset, $12,000 divided by 6,700. It gives you 1.79. Remember, the rule of thumb here is if it exceeds 1.5, then it's considered pretty good. Right, we want to have this ratio as large as possible. That means we have enough current asset to pay off current liability. So this is a good sign. For debt ratio, $14,500 over $27,000. And the rule of thumb is about 0.6. Right? So anything below 0.6 is considered pretty well as well. It means you have enough total asset to cover total debt. So both of these ratios will tell you that the sign is pretty well in terms of financial position, paying off current liabilities and long-term liabilities. Okay, so last line here really just means for every dollar of liability, you have 1.79 current assets to cover for it. That's what the ratio means.